Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
All right, so I don't have, okay, I just wanted to check the questions real quick here. Let's see what we have here from John. And he's asking a question about the placement of the short call and the short put. I will address that when we get into the strike, so just sit tight and I'll be sure to get back to that. All right. So this is a screenshot of TradeKing's probability calculator. What you would do is you put in your symbol here and you would hit go. And it would give you some default content up here, the default numbers. What I did was I changed this to the June month because that was the time frame I was looking at, about 51 days to expiration. And then it will populate the numbers for June. It will give me the at-the-money vol in June, the interest rate for June, dividend yield, and so on. Once I get this information up here, the information down here will fill in, all right? And this is the standard deviation. So notice it's got -1, -2, -3, +1, +2, +3. These are the standard deviation moves, okay? So the first standard deviation says that the lower boundary of 675, let's round up, and the upper boundary of 792, this says that there's a 68% chance that the underlying, which is currently at 735, there's a 68% chance that between now, which is early May, and June expiration, that the underlying will be between these two numbers, between 675 and 792. Okay? 68% chance that the underlying, which is currently at 735, will remain between 674 and 792 between now and June expiration. All right? Then there's a further out range, right? This is the second standard deviation move. It goes down to 623 and up to 858, and that's 95% chance that it will stay between these two numbers. And then finally, a 99% chance between this number and this number. Okay. Now, what this tells me is it gives me a basis of selecting the short strikes of my iron condor trade. Okay. So I'm choosing, so I know kind of like where my probability lies. Okay. There's three parts of any option trade. Actually, I should say of any trade, but we're talking about options here. Three parts. There is how much risk you're taking. There is how much reward you could possibly get, right? And we're talking about a percentage basis here for both of those items. And the third item, though, is the probability that either of those things will happen, right? Because if you say, well, you could make 20 bucks, but if I lose, I could lose 100, well, at face value, that doesn't sound so great, right? But if I tell you, oh, there's a really high chance I'm going to make the 20 bucks, and there's a low chance I'm going to lose 100, now things are different. And that's what the probability calculator is all about. So it's giving me the strikes based on standard deviation as a guide to choose which strike prices. So what I did then was I went back to my chain, and I saw that strike prices that were close to 675 and 792 were 670 and 790. Okay? Because just because these numbers come out down here doesn't mean there's actually strikes that correspond to those numbers. So you need to figure out what works for you. I chose those numbers, I put them in here, and I hit this button here, calculate. What happens here is that it then fills in these numbers up top. All right? And you can see that it's telling me there's over 69% chance that it will finish between my target prices. That means that at expiration of June, there's a 69% chance that it will the underlying will be between 670 and 790. It's a little higher than one standard deviation because I chose strike prices outside of the first standard deviation move. What I also get, though, when I do this is it tells me this probability of touching, okay? Well, what does that mean? Well, so far we've only talked about between now and expiration, like what's going to happen at expiration. But we don't live in a vacuum. Things fluctuate, right? And that's what makes the market. So what's going on here is this is saying, well, between now, any time between now and expiration, the underlying could touch one of these strike prices that I've entered in up here and then trade back, okay? And what's the probability of that happening? Well, for it to go to the upside, it's 36%, and for it to go to the downside is 25%. Okay, so this kind of tells me something about my potential stress level, if you will, right? And there's going to be some fluctuation here, no doubt. There's a 60% chance, if you will, that it's going to touch one of my strike prices. That's kind of high, right? But the thing you have to remember is if I'm looking for like a 90% success rate trade, that's all well and good, but the potential reward for this really, really high success rate trade is going to be very, very low. So you need to balance those three parts of the trade. You need to balance the risk, the reward, and the likelihood of the reward or the likelihood of the risk all together and make the best decision you can for your financial picture, your risk tolerance, your trading stomach, if you will. All right, so keep those in mind. Now, John asked a question about, which one am I using here? So do you always place the short put further from the at the money than the short call? And the answer is no. It depends on what I think is going to happen. Now, just a brief statement here about log normal, okay? There's a model within the probability calculator, and that's how these numbers are kicked back to you when you enter in the parameters. And the log normal model says that there are more potential price outcomes to the upside than there are to the downside. That doesn't mean that the model is skewed bullishly. It just means that mathematically, the index that's at 735 can go from 735 to 2,000, if you will, or higher, but it can only go lower to 0, right? So the space between 0 and 735 is 735 points. The space between 735 and 2,000 is much more than 735 points. And so because of that chance, that needs to be reflected in the model, and that is what log normal means. So oftentimes, it will give you a further out-of-the-money call in dollars, if you will, for that first standard deviation move than it will for the put side. But even though that's what the model is giving me, that's not necessarily how I'm going to trade it. If I'm more concerned that the index is going to decline rather than increase based on whatever's going on in the market at that time, I'm probably going to go with a further out-of-the-money put, even though the model is telling me something different. Again, the model is based on what you put into it and how you use it. It's not the end-all, be-all of your option trade. All right, so let's continue here, and let's go on.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.